G'day everyone, Greg Canavan here. Today I'm joined by Michael Goldberg from Collins Street Asset Management. Very excited to have this conversation today. Michael and Collins Street is a deep value asset manager, so very much along the lines of what we're trying to achieve here with a contrarian portfolio of concentrated stocks. So, Michael, welcome to the podcast, and looking forward to this today. Maybe we can just kick off with giving a little bit of background and context around what you do there at Collins Street, and we'll go from there, mate.
No worries, Greg. Thanks for having me. It's a pleasure to be here. I suppose the genesis of our business goes back about 10, 11 years now. Vas, my partner, and I, we were working together at a wealth manager, and we had a deep love of, I suppose, turning over rocks and doing the deep dive due diligence research to uncover gems of investment ideas. And, while part of our job was certainly that, not enough of our job was that. And so Vas and I looked to go out on our own and launch a fund. We were looking to build something that we would be happy to invest in as investors. And so we built it around, I suppose, the feedback that we'd receive from our investors over the journey, but also what we'd like to see within a portfolio. And there were some key things that I think stood us out as different to the broader market. Number one, we fundamentally believe that you want to invest in your best ideas. Like you mentioned, having a concentrated portfolio is key to our philosophy. And perhaps number two, the thing that sort of sounds most different to a lot of what you see out in the broader world is that we decided that it was too much to ask for a performance fee. Sorry, it was too much to ask for a management fee if we're not performing. And so rather than having a fixed management fee, like a lot of funds out there do, 1%, 2% plus performance fee on the top, we said, you know what, if we don't succeed, if we don't generate a profit for our investors, we don't think it's appropriate that we take a fee. And so the only fee that we do have for our flagship fund, the Collins Street Value Fund, is a performance fee. Again, if our clients don't make a real profit, we don't get paid a fee. And certainly that runs the risk of my children having to suffer hand-me-downs during dry periods, or Vegemite and toast for breakfast, lunch, and dinner if things were to go pretty terribly. But we had faith in our ability, and thankfully we kicked some goals early and have continued to kick some really good goals. We've been running now for about 9 years, and as of the end of the calendar year, we're running at about 12.5% per annum over the journey, which is pretty good. I think especially so given how difficult it's been for, one, value investors, and I think two, any investors who aren't investing in the Commonwealth Bank or any of the big four banks, or the top 20 or top 50 stocks. So, we've been finding value outside of the top 50 recently. And so, being able to generate 12.5% over the 9 years or so has been a really good outcome for us.
Yeah, I'm looking forward to getting into some of the conversation around where you see the value in the market now. I've got specific questions on the energy sector, the gold sector, which I know you guys set up a special situations fund some time back to take advantage of the fact that gold was very unloved a little while ago, but now obviously very different story there. So looking forward to getting an update there. I just wanted to touch on something you mentioned. You're running at a bit over 12%, 12.5% annualized returns in the flagship value fund. And you say that has been delivered by a combination of patience, conviction, freedom, and objectivity. I think a lot of the times that these qualities are glossed over by investors, and people don't really look at what some of the attributes of getting that strong performance. And to put in context, that is decent performance for a longer term time frame. I'm not sure exactly what the market's done over that time frame, but generally the longer term performance of the market, including dividends, around 8.5%, 9%. So 12.5 compounded longer term is significantly better than that. So could you just maybe touch on a few of those things: the patience, conviction, freedom, and objectivity that help to deliver that performance?
Yeah, look, I think one of the challenges that all investors face, I think particularly value investors and perhaps even more so people who are happy to be contrarian, is that from the moment you buy something and announce it to the broader market, people tend to think that you're crazy. These are unloved businesses. These are businesses that aren't properly understood by the broader market. If you get it right, people call it a fluke. And if you get it wrong, you get told, I told you so. But what we've found historically is that it takes time for an unloved company to become appreciated and then eventually loved. Sometimes you get lucky. We've certainly bought stocks that we thought were deeply unloved and deeply, far too cheap relative to their prospects, and we've seen those companies taken over within a month. But on the flip side, we've owned companies for 4 or 5 years before we've seen a transition from unloved to appreciated and then eventually loved. So patience is certainly a virtue and a very important one. I think part of our job as investors is arbitraging the time it takes to recognize the value. And I think, especially nowadays, with the myopic sort of approach that most investors take, the TikTok generation, I think the discount rate on the time value of money is far too high. So there's certainly opportunity over there. Without conviction, you can't really start. I mean, I think one of the challenges for investors is not just about getting good returns. It's also about being comfortable and sleeping well at nighttime. If you don't have conviction in your idea and the stock moves against you, then that can be a very, very uncomfortable experience. Certainly, we've seen stocks that we own, knock off 25-30% from the time we bought them. And if all you've got to judge whether you were right or wrong is the performance of the share price, and that can be a really uncomfortable period. But if you know the business and you understand the business and you know why, you can appreciate what the market thinks and why they're wrong, then a drop of 30% isn't a problem. It's an opportunity to average down and buy some more. And I think to the last point you made, or perhaps the other key point amongst those terms is that we're not beholden to holding any particular stocks. If we don't see value in a particular area, we just don't invest there. And I've seen far too many times broker reports or even fund reports or analysts come out and talk about how they don't like a particular company for reasons A, B, and C. And then instead of saying we're not going to invest in that company, they say we're going to go underweight in that company. And again, I appreciate that approach for a broadly diversified portfolio. You need to have a little bit of everything just in case you're wrong. But if you're going to go and spend the time and the effort to understand these businesses, it seems to us that you should be investing more in the businesses that you think have the greatest prospects, and nothing in anything else. So I think that pretty much that sums up, I think, those key terms that you mentioned.
Yeah, absolutely. If you're going to be underweight something, you may as well be 0% if you don't have the conviction in it. I agree wholeheartedly. I was
Well,
going to ask.
Let's be honest with ourselves. If we're serious about our ability to pick stocks, then you should be concentrated. If you're going to be concentrated, you're probably talking 5 to 10% of your capital in any given idea. I mean, how much space do you really have for stuff that's kind of okay or not quite right? There's not a lot of wiggle room, I don't think.
And how much space mentally and intellectually do you have to follow 30, 40, 50 companies and really know those companies well? So, to me, the concentrated approach makes sense from a delivering outperformance perspective, but also from the ability to follow those companies closely enough to know exactly what they're doing, what the valuations are, have a good sense of those sorts of things. Speaking of valuation, I wanted to ask you, I think value is a word that has so many connotations in the market. Most of us grew up following Buffett, following Munger and the great value investors. And over time, that value school of investing has developed this idea that, it means low PEs or high dividend yields or low price to book value, some sort of mechanical metric. But there is so much more to value investing than that. And I was just wondering what your take on that was from your firms. Like, how do you guys see value investing?
Yeah, look, that's a cracking question. It goes to the heart of, I suppose, everything that we do here. But I think the challenge that people have when they try to pigeonhole or define something is that, particularly when it comes to value investing, there's no really agreed, defined definition of what value investing is. You mentioned some of the greats. Obviously, you've got Ben Graham, who was the granddaddy of value investing. His bread and butter was what he called cigar butts, where you can essentially pick up a company for less than the value of the fire sale value of its assets. That's, I suppose, at the heart of it, the general concept of what value investing is, buying something for a discount to what its intrinsic value is. Warren Buffett certainly evolved that understanding somewhat. Charlie Munger evolved it considerably in his work with Warren Buffett. But, you've even got Peter Lynch, who perhaps wasn't as concentrated as what we might like to be, but certainly a value investor. And I think when trying to define what value investing is, we get caught up in a specific line in the sand. And to be honest, when it comes to fundamental investing, you've probably got a spectrum. You've got a spectrum from Ben Graham on one end who invests in cigar butts or would like to invest in cigar butts. And on the other end, you've got Phil Fisher, who ascribed value to what's going to come next. And, where exactly along that spectrum the line is drawn, that on the left is value and on the right is growth. It's very, very hard to specifically define where that point is. But I suppose from the 10,000 feet view, the way we look at value investing is that we're trying to buy $1 worth of assets or earnings for 50 cents. Now, I appreciate that might sound pretty obvious, but I say it to distinguish ourselves from growth investors. Again, even though I've just said it's hard to define where growth investors separate from value investors, technical investors and even speculators who might go and buy a company for $1 today in the hope that it will be worth $2 plus at some point in the future. Again, a lot of people have made a lot of money taking that approach. That's just not how we view our role and not how we view value investing per se. So certainly, different valuation metrics are important. Low PE, price to book, ROI or ROE. Dividends are a good one if they're reflective of free cash flows and not just artificially created through some sort of accounting magic. And certainly you want to have a look at what the discounted cash flows are worth. But you're right, a business is not just a matrix of those metrics. Unless, again, you're just buying cigar butts. Management's important. The sustainable competitive advantage of a business, which locks up its potential earnings into the future, are important. Aligning management's interests with shareholders is important. Again, you want to make sure that the incentives are aligned to make sure you get the sort of outcomes that you would hope and expect. And of course, I think the key role for directors and boards is the proper allocation of capital. So all of these things sort of are inputs that go into our research and our efforts to understand if a business is A, good, B, cheap, and C, worth investing in. Again, I think fundamentally what we're trying to do is we're trying to buy, apologize for repeating myself, we're trying to buy $1 worth of assets or earnings for 50 cents. And once we see that value or that intrinsic value achieved, we look to sell. The magic, of course, is in working out, how do you work out that $1 of earnings?
Absolutely. I guess this is a related question, but you mentioned Ben Graham before, and I've got one of Ben Graham's quotes on my desk that I look at just about every day, and it says, "To enjoy a reasonable chance of continued better than average results, the investor must follow policies which are inherently sound and promising, and two, not popular in Wall Street." And I always try to remind myself that if something is popular, then it's very unlikely to give you the opportunity to buy 50 cents for $1. So I just wondered how you guys think about that in the context of we're trying to beat the market. That's how I get paid. I get paid by delivering performance to my investors. In a market, up until we're recording this on Friday, the 21st of February, and we've had a weak market this week. And I'm not saying that values come back into the market, but we have had a pretty stretched market leading into this. And there's been pockets of opportunities, but more broadly, the market has been difficult to find those opportunities. So wondering how you guys go about that from what's not popular, and not just buying something because it's unpopular, buying something because it's unpopular and inherently sound as well. That combination is an important one.
Yeah, look, I mean, just fundamentally, I think that's a great quote. Probably worth having it on my desk as well, to be honest. You've got to have a process that stands the test of time and also stands the test of your personal biases or subjectivities. I think that's super important. I think you have to recognize that investors can get lucky, and that can give the appearance of success. But if fundamentally you've got a flawed process, you will ultimately give that money back. And like you said, you've got to look where others won't to find opportunities that others don't. I suppose, I mean, you hit the nail on the head. The market has been very, very interesting for the last couple of years. I think you've almost seen, almost two markets. You've seen the popular stocks, which is a rather concentrated portion of the portfolio, and then you've seen everything else. You have a look at our market at the moment, and our biggest stock at the moment is Commonwealth Bank, which is, I think, by quite some distance, the most expensive bank in the world. Yet you've seen margin expansion from, I don't know, a couple of years ago, probably 16, 17, 18 times to now trading on 26 times. So if you're looking where everybody else is looking, that's what you're going to find. You're going to find all of the different stocks that all of the institutions and all of the super money is flowing to. And those stocks are both loved, and very well understood. So they're fully priced. To find opportunities, you've got to look, like I said, under some rocks. I think over time we've done quite well at that. Um, you know, certainly looking under rocks is helpful, but it's not the answer in and of itself. You've got to do the fundamental work you've got to go through a process to make sure that they're attractive. But just some examples, we we were introduced to uranium companies, to nuclear energy back in 2017. Vass, my colleague, was having a chat with one of his brokers who was spruiking whatever the most recent fanciful, exciting tech stock was, or whatever the case may be. And I could see in his face that he was disinterested, but he was being polite. We're nice guys. We like to engage with brokers. They add an important aspect and value to our role. But I could see that he was disinterested and it wasn't going anywhere. And so I just scribbled very quickly a note. I said, Vast, ask him what idea he really likes, but feels uncomfortable sharing with investors, right? Because it's always easier for a broker to sell something that's exciting than to sell something that's not exciting or unpopular. And so the guy said, have you ever looked at the uranium market? And we said, no, we hadn't. And he gave us a quick rundown and basically outlined that at the time, spot prices were for a pound of uranium were around about $18 or $19 after there were some big cuts from the Kazakhstanis and the Canadians, who are the biggest producers of uranium in the world. And the average cost of production globally was about $45. So that sort of got us quite interested. I mean, either you've got to decide that we're going to turn off 11 or 12% of the global electricity grid, which is probably unlikely, especially given the world we live in today, or something's got to give. So we did some research and we ended up buying a basket of locally listed uranium-based companies. Did absolutely nothing for 4 years, and then, pardon the pun, exploded all at once in 2020, 2021. More recently, we invested in offshore oil and gas services companies. We had a real interest in MMA offshore, which, again, deeply, deeply unloved at the time. We understood why it was unloved at the time. It was not politically correct or culturally appreciated to be investing in things that were related to oil and gas or fossil fuels. And so there was an opportunity there to buy this company that was trading at 20 or 30% of its net tangible asset backing. And I appreciate for seasoned investors that when you hear NTA, you can roll your eyes and wonder what that really means. But we were seeing them selling some of their equipment for NTA and higher. So again, we made some really, really good money out of there. At the moment, again, I'm going to say some brand names, and you're gonna cringe, but that's kind of the point, right? We're looking where other people aren't looking to get opportunities that others aren't finding. At the moment, we're invested in Retail Food Group, which is a deeply, deeply unloved brand. Fundamentally, a pretty good business, trading on ridiculous multiples in our view. Management have been completely recycled over the last 3 years, and with Peter George in charge now, we think he's doing a really good job of getting the business back on track. But again, it's still living with the impact of the way they poorly treated their franchisees 4, 5, 6 years ago. Seven West Media, another really, really unloved, misunderstood business, trading on a multiple of 4 times. Certainly the cheapest media company, I would think, in Australia, possibly amongst the world's cheapest serious major media companies. And then one of perhaps one of our largest positions at the moment is oil and gas again, but direct ownership of oil and gas in a smallish company called Contrarian. They're trading at a discount to their cash and cash backing. So certainly, I think as a value investor, you've got to be more concerned about being right than being liked. And that's not an easy thing to get over. But if you can get over that, there are some absolute fantastic opportunities out there in the market. If you've got the patience, where you can buy in before the market appreciates that value, and then wait until the market catches on. And if the market doesn't catch on, then there are mechanisms. If the market doesn't recognize value, then a competitor will, or a private equity firm will, or the company can do capital management via big dividends or distributions or buybacks. Ultimately, we do find that given the time, water does find its level, but it can be quite a journey from unloved to properly appreciated.
So how do you handle the, I guess, emotional journey for that to unfold? I mean, you mentioned before 4 years for the uranium stocks. There was a time there during that holding, so I was sort of involved in that sector myself, where the world was just going green. Everyone thought that solar panels and windmills would take over uranium. There was no place for that in the world, despite it being zero emissions and the most energy intensive form of electricity generation that we have in the world. What do you think this is an innate thing that fund managers have to be contrarian, or is there something that you need to work on in terms of being, I don't care if I'm liked, I just want to be right? Because at the end of the day, humans are tribal, emotional creatures. We crave living within consensus. And I think if you can recognize that, that gives you an opportunity to outperform because you can see where consensus gets it wrong. But again, it is sometimes difficult to remove yourself and be an observer of the market rather than be involved in the day-to-day of it and not observe what's going on. Just wondering, do you have a process to manage that, or is it something that just is comes naturally to you?
Look, there is certainly a personality type that likes to challenge the status quo, and I probably fit within that quorum of people. My wife often complains that when we buy IKEA furniture, that the instructions are in there to be followed. You don't have to go your own way all the time. So, being contrarian has worked quite well for us in picking stocks, not so well for us in putting together IKEA furniture. But, in terms of not getting emotionally impacted by share prices, I think it's a learned skill. I think that it's a lifelong learned skill. It's inevitable. It's inevitable that when you're betting against the market, and particularly as we've just discussed, when it takes time for some of those ideas to come to fruition, that you're going to question your thinking and your decisions. And I think that's fine. I think it's probably even healthy. I think the trick is to be intentional about it. Be rigorous in your reviewing of your ideas to make sure that things hadn't changed and that the idea that you thought was great continues to be great. It's not easy, but I think the first step is, and we've discussed this point already, is that you've got to have conviction. You've got to have conviction. You've got to have done the work to be comfortable in the stock that you've bought. I think the other important tool to keeping emotions out of it is to have a sounding board. I've spoken about it in my quarterly reports, and I talk about it often when I catch up with clients. You want to have an investing buddy. So I'm not talking about a mentor, which is important by itself, and I'm not talking about somebody who is a junior who can just do some research for you. I'm talking about a genuine compatriot who, when you test an idea originally, they can push back, and you can have really rigorous debate about that idea. And then if your conviction wanes, you can touch base with that person again and ensure that the thesis is still intact. And I think that is an underrated tool that not enough people use. And I'm very, very grateful and thankful that VAS has me, and I hope to think that. Well, certainly I have VAS, and I hope to think that VAS has me. It's required. But it's often very easy to convince yourself, if you're not accountable to anybody else, that something has changed or that you got it wrong or that something's a great idea when it's not actually. If you're trying to present an idea to somebody else, it takes a much deeper level of understanding, and the thesis will stand up much stronger and much taller if it's deep enough and understood enough that you can give it over and convince some third independent party.
Do you find that if you go public with your calls, and I remember reading something about you guys, correct me, or you might want to let me know what actual year it was because I can't remember now, but and this is what sort of, I guess, got me onto your line of thinking in the first place. Was I was bullish on gold, and look, I've been involved in gold for many years, so gone through bull markets, bear markets, but there was a time a couple of years ago when gold was clearly a good contrarian play. Gold stocks had been completely unloved, and I think you guys set up a special situations fund to invest specifically in these undervalued gold plays. And the Fin Review did an interview at the time, so that was obviously a public call. To what extent does being public with a call influence your conviction, or do you think you should stick with it? How hard is it to change your mind once you've gone public with something? And I ask that because as someone who writes to thousands of members every week, my thoughts, my calls are very public. So I'm constantly thinking about, am I holding on to this idea because I don't want to go back on it, or just to make sure I'm being rigorous in my own thought processes. Just wondering how you guys think about that as well.
Yeah, look, it's I suppose part of the same question. Like, how do you stay unemotional about something? And that's certainly much more difficult once you've gone public with an idea.
Yep.
And look, we've certainly had that conversation in the office. And again, you've got to recognize your biases. I think once you do go public, it does make it a little bit harder. But again, we have a broader team in here, and just because I've gone public about something doesn't mean that we can't change our mind. You've got to go back to the fundamentals. Much like we keep track and a booklet of all of our ideas and why we invested in them, so we can go back and have a look at it later. Just because we've gone public doesn't mean that we're locked in stone. And so, if things change, we have to change as well. And we've certainly had occasions where investors or potential investors have reached out and said, "Hey, you guys said you were buying company ABC at a particular price. It's gone drastically backwards. How do you explain yourself?" And we would say, "Well, yeah, we said that back then, but you fast forward a couple of months, stories change. Our job is not to, we're not a media organization. We're not a stock tipping sheet. We're a fund manager. Our job is to do what's in the best interests of our shareholders. And of course, you can't mislead the markets. I'm not suggesting for a second that would be appropriate. People have gone to jail for that, but it's not my job to inform the wider world of every change that we've made. And sometimes, within our conversations with Vass, that sort of line has to be brought up. But certainly, our job is to get the best returns. And I suppose I'm so keenly invested in the returns that we can generate for our investors that getting over that emotional hump of having said it publicly and then changing my mind is something that we do and can do without too much drama. But you're right. Certainly, once you say something out loud, it does change how you feel about that company. Again, it's recognition of your emotions and then being intentional in how you deal with those emotions.
We talked about consensus and patience and all those sorts of things. I find it a little ironic that you guys are called Collins Street Asset Management in the heart of Melbourne's financial district broker community, yet your value contrarian. I mean, if you think about Buffett, who camped out in Omaha for his entire career to remain aloof from Wall Street and all its influences, how do you find that?
Look, I suppose our secret shame is that while we're called Collins Street Asset Management, we're actually on Little Collins Street. So perhaps one day we'll grow into our name and move on to Collins Street. But look, I think while we are geographically very close to the brokering world and the investment banks and whatnot, I think culturally speaking, it would be hard to be much different and still be in the same industry. And I think perhaps the best example of that is if you hark back to our earliest beginnings, we were just down the road or still on Little Collins Street in an office that we'd gotten a great deal on from somebody that we had a connection with. Value investing is important, both in where you allocate your capital in the stock market, but also in how you buy your furniture and how you negotiate your rental agreement. So we got a really good deal.
It's a way of life.
It is. It's often interesting to see, does a person's philosophy flow through beyond what they present in the broader world or not? And I think one of the most interesting studies that I've seen, it was completely anecdotal, but it was interesting, was in the US a few years ago. Someone did an assessment of returns generated by a fund or a brokerage house and the correlation as it related to the kinds of cars or the average cost of the car in the garage of said institution. And they found again anecdotally that there was a negative correlation. The more expensive the cars downstairs, the poorer the performer upstairs. But we got this little place. It must have been about 30 square meters, and we had some ideas of once we got in there how we'd make it up to make it more user friendly or whatnot. And we turned up, and it had previously been somebody else's boardroom, so there was a big boardroom table in there. And Vass and I looked at each other like, yeah, that works. So he went on one side of the table and I went on the other side of the table, not on ends, but opposite each other so we could engage in conversation. And, when we had a guest come, be it a ASX listed company, and we had some serious ASX listed companies, or, Joe Smith, the farmer from down the road, whomever else was in the office would scoot down to one end of the boardroom table and the meeting would be held on the other end of the boardroom table. It was often interesting to see how those conversations developed because there's no real privacy. So it became a running joke that Vass would drag me into the conversation and I would drag Vass into the conversation. But, we were adding value and it was a good time had by all. Rob, one of our distribution guys often says that we buy our furniture in the same way that we pick stocks, and we have a lifetime platinum membership to IKEA furniture. Look, certainly relationships within the industry are very important, but I think it is possible to be in the geographic area of Collins Street and not buy into a lot of the culture that might prevail. And again, most of the people that I meet don't suffer from that negative culture, but I understand what you mean by the brokerage culture. Certainly, brokers are very important. They provide us with data, they provide us with access to markets, they provide us with reports which we can measure and assess our ideas against their opposite view. So there's certainly a intrinsic benefit in being close by, but in terms of taking on board the investment banking culture or becoming reliant on brokers in terms of our research, that's something that we seek to actively avoid. It's very hard to identify an information advantage if your source of knowledge is the brokerage world, which by definition, their job is to sell ideas. So how much of a head start and how much of an information edge are you going to have if you've received it from somebody whose job is to sell it to the broader world? So we tend to get out there and do our own research. We've found ourselves, essentially kicked out of an IGA when we were doing research for Metcash. Being an Orthodox Jew, I don't get to taste all of the delicious foods of the companies we invest in, but Vass certainly has had many occasion to taste and experience many of the companies that we've looked to invest in and their offering. I mean, there was even one time when we were looking at investing in a company that promised that they had a solution to regrow hair. I know it sounds like the script of
Never
a
heard of
movie.
that
In fact,
before.
I think I have seen that movie.
Right, we'll get into the market talk in a moment, but I just wanted to take it on a slightly philosophical path first, and it's in relation to something that you wrote in the December 23 quarterly. Now, for viewers out there, if you want to get insightful quarterly reports from a fund manager, I highly recommend signing up to your quarterly updates. They're always well written and thought provoking, which you don't often get in the world of funds management. So. The 2023 one, the topic was change. I think you mentioned that the only, people tend to think the only constants in life are death and taxes, but change is an important one as well. It's something that I always consider as important as an investor and as a human as well, just to constantly try to evolve and to change. Just wondering what your thoughts are on that in terms of generating that strong performance and really trying to sort of keep on top of the market. Because one of the things that you need, I think one of the things that's characterized good investors over time is their ability to endure, their ability to go through cycles. And obviously you have to have an adaptability to go through those cycles. So just some comments on that would be interesting.
Hey, it's almost a philosophical question as much as it is an investing question. But you're right. Look, change is one of the few, I suppose, constants in life. It's where all the opportunities come from in investing as well, and it's where all the where all the success eventually, what all the successes are eventually driven by. But I had a teacher once when I was studying overseas who said that the two important points when planning a journey is to, number one, know where you want to go. And I think most people have a sense of what they want to achieve. And number two, know what your starting point is. And I think knowing what your starting point is a much more complicated concept than knowing where you want to get to. And I think the challenge is that if you're just floating in the ether with some esoterical goal in mind, it's very hard to plot a journey. And that's particularly so when spanners get thrown into the works. Change is inevitable in life, certainly, but even in investing. Companies are organic. They have changes in management. They have changes in focus. They have changes in capital management. It's the change that drives the outcomes. And I think any plan that doesn't account for where you start, no matter how great a plan it is going to fail to get you to where you want to be. I think the trick is recognizing that change is inevitable and being flexible enough to deal with it when it comes up. I don't think it's a particularly complicated idea. I'm somewhat surprised that it was a topic that was even worth writing about. It seems to me self-evident that change is one of the major impacts on people's lives, and without the ability and flexibility and understanding to deal with it, you're dead in the water. Again, we wrote about it because it was an interesting concept. But sometimes I wonder some of the things we write about why they need to be written about. But certainly, I'd agree with you. I'd agree with you. Change is inevitable, and our job is to learn how to manage and deal with that change when it does eventuate.
All right, let's get on to the markets. As I said, we're recording this on Friday, the 21st of Feb. So we've had a rough week in the markets from I guess, a headline perspective. We're in the middle of reporting season. There hasn't been a day where there's been a bunch of reports where you've seen some pretty significant falls of some major stocks. But on the other side of the coin, you've seen some pretty big rallies from some of the more unloved parts of the market as well that might have surprised from having not as bad as expected results. As it stands now, where are you guys seeing the contrarian opportunities in the market, or are there?
Look, there certainly are. We touched on it very briefly. I think it's always hard to pick stocks that are going to succeed. To suggest that it's easy is silly. Um, certainly, certainly, it doesn't need to be complicated, but easy. Easy it certainly is. And I think, as we discussed earlier, we've seen a two-speed market, and you see it most. You certainly see it in big caps versus small caps, but even within the big caps, you've seen a big dislocation and disparity in the returns generated by the different sorts of companies. I was looking at the ASX 20 for my most recent quarterly report to try and grasp how the market had done on a more granular level. And I found that if you look at the top 20, the ASX had done about 7.5% for the calendar year. If you took out the big four banks and Macquarie, that return dropped to minus 1.5%. Right? So there certainly is opportunity looking outside of those most broadly and well covered stocks, where you can identify value. But the question really is, when is that intrinsic value going to be recognized? And in a world where you've got to go to a lot of time and effort to do price discovery and to identify these opportunities, I suppose the question for your average investor out there is, well, why not just buy Commonwealth Bank? Buying Commonwealth Bank and watching a margin expansion over the last 10, 20, 30 years has been a wonderful strategy. But I think the risk is, unfortunately, that the greater the dislocation between value and share price, the greater the snapback. Now, that's probably not great news for companies that have become very, very expensive. And again, like I said, it's not across the board. That's worked really, really well with CBA if you pick CBA. Probably not so well if you pick BHP or CSL, which are the second and third largest companies. And we hope that that's good news for the companies that have been left behind, trading on single-digit multiples. I suppose the counter argument might be that the massive amount of flows from the structural flows from our super system and our institutions just means that large caps are going to be more expensive or become more expensive for the long term. But again, that doesn't seem to have worked for the likes of BHP and CSL over the last couple of years. So look, ultimately, and again, I think we touched on this point, I think ultimately the power of cash flows generates share prices. There are a lot of companies out there that are unloved, perhaps a little bit smaller, that are trading at exceptionally low multiples. I think eventually the market will wake up to that, either on its own, either by mergers and acquisitions or some sort of corporate activity, or by an increase in dividends, distributions, or buybacks. Eventually, like we said earlier, water does find its level. It's really a question for us about when, not if. And I'm cognizant that there are plenty of quotes out there about how markets can stay irrational longer than you can stay solvent, but it goes back to our earlier point about being patient. And I suppose for a person in my position or a fund manager in general, ensuring that you've got a client base that are on board with that process, with that policy, with that philosophy, and have the patience to come along on that journey with you. Because again, it took us 5 years before we saw any returns in the uranium space, and that was some of our best returns over the last couple of years. That tends to be how it is. Companies stay unloved for a long time until all of a sudden something goes click and they become appreciated and loved, and then the share prices rocket up.
You mentioned oil and gas before as being one of those sectors that is unloved. Maybe you can talk about that in general, but also I'd be interested in your thoughts on the coal companies and whether you get exposure to commodity prices or whether you're more in the commodity services types things. Because I look at, we've got a couple of coal stocks in our portfolio. Yes, the coal price has been weak lately, but they're generating significant cash flows at these levels. Whitehaven come out yesterday with a buyback announcement. Wasn't large relative to its market cap size, but just the fact that it's signaled that it thinks its shares are cheap. It's given it a good strong rally. Yancoal came out last night with a strong divvy. Its half-year divvy represents a 9% fully franked dividend yield. So these companies are significantly undervalued if you think the commodity prices are going to hold up through the cycle. Just wondering what your thoughts were on the coal companies and oil and gas in general at this point.
Yeah, look, we have a significant amount of our portfolio exposed to oil and gas. I think probably a little over 20% of our portfolio is exposed to that space. We have invested in coal in the past, and but we don't own any coal stocks at the moment. That's not to say there isn't value there. I think a good argument could be made that we have enough energy exposure, certainly traditional energy exposure, that there's no need for us to go looking for other ideas when we're satisfied with the ones that we've got. It's been very interesting to see the shift in the culture and the conversation around traditional energy. I think if we were having this conversation, you know what? I'll take that back. I don't think we could have had this conversation 2 or 3 years ago. I think just the idea
I would have been
that
happy to have it, by the way.
well, we weren't having the conversations per se, but we were quietly investing in the space. Yeah, when we first bought MMA Offshore, it was probably 4 years ago now. The idea of investing in oil and gas or fossil fuels or traditional energy was it just wasn't something you can bring up in polite company. And I remember after we discovered MMA, as part of our research, we uncovered that there was just this massive opportunity for offshore oil and gas service companies, particularly drillers out of the US and Europe. And we launched our first special situation fund. So the way our special situations work is that we're not out there looking for new ideas. Our focus is on the value fund. And if something pops up that doesn't fit the mandate or is a step too far for the mandate of the value fund, if we think it's a good idea, then given our relationship with our investors, we suspect that our investors will think the same. And so we provide an opportunity to invest in that space. And so we did that for offshore oil and gas. And I recall having a conversation with my brother, in fact, who is a bit more progressive and a bit younger than I am. And he liked the idea. He understood what we were pitching, but he said that he couldn't get emotionally over the idea of investing in fossil fuels and the impact on the broader environment. So I pitched to him that I accepted his concerns. I didn't necessarily share them because I'm not sure that fossil fuels in the world we live in today is necessarily a bad thing. Certainly, I'd like to see a transition to a more environmentally friendly power grid, but we've got some way to get there. And if you turned off oil and gas or coal, I think you'd find, as much as a third of the world would freeze or starve to death pretty quick smart. But I suggested to him that if you're genuinely concerned about the environment or those sorts of things, invest with us and take your profits and support different organizations that support the causes and concerns that you share. So ultimately, he was convinced. But it was very interesting when we were talking about the idea to clients and potential clients that there was no gray area. Either people were on board that it was a great idea to be contrarian and invest in this space, or people were aghast that we could possibly be investing in traditional energy. And I think where we find ourselves today is in a very different world where people can take a step back, I think, generally speaking, and assess the investment on its merits and make a decision. But I still think that we're seeing an overhang of perhaps 2023, 2022 and earlier, where a lot of these energy companies simply haven't gotten the appreciation that they deserve, not from the investing community, not from the financing community. And I think there's opportunity there, certainly. Whether you're better off investing in uranium stocks, whether you're better off investing in coal stocks or oil and gas stocks, I don't know. I suppose time will tell. But there's certainly opportunities still in what is still unpopular spaces.
I think that goes to the heart. What you said before goes to the heart of contrarian investing, right? Like when you were pitching those ideas, because I remember 2021 was, I think, the two stocks I recommended at the time, Whitehaven Coal and Origin Energy, and they were completely out of favor, completely unloved. And they were the type of opportunities I was looking for. I feel like when there are significant companies that have significant businesses that no one wants to talk about, you know you're onto a pretty good thing. And it's just a matter of time before the market decides that's the case. Now, with Whitehaven, I think the turnaround happened pretty quickly. By 2022, that was moving up strongly. But with Origin, it took a little bit longer. But this was even after Origin had announced its investment in Octopus, which was clearly going to be a major investment for it. So it's just a matter of time before the market sees what you can see with clear eyes and with an absence of emotion. I think that's one of the keys to not only value investing but contrarian investing. So just on the energy space, are you looking in because you've got some large energy stocks and then it goes down into the smaller space where I guess production's more variable, the liquidity's more difficult. Are you spread across the large and the smaller area of the oil and gas sector, or?
I mean, we've found most of the opportunity in the mid space or mid and smaller space. That's not to say there's not opportunity and value in the large cap. I think within the energy space there certainly is, but where we've found ourselves has been more in the mid and smaller cap space. We did have a
Care to
fairly
share any
significant.
names?
Well, we had some Beach Energy. We've recently exited Beach Energy. I think we first got in after, I don't remember if it was the second or third or the fourth round of downgrades, but we got in around about $1.05, perhaps 2-3 years ago. We sold a lot of it at around about $1.80, and then more recently sold around $1.40, $1.50. A Carnarvon, like I said, is a stock that takes up a big portion of our portfolio at the moment. They've got a big project off the coast of Western Australia. It's a joint venture with Santos, and they are of course beholden to Santos and their interests and when they decide to move the project forward. And so there's been some challenges there, but they're trading at less than cash backing. They're sitting on a project that has likely about 500 million barrels of oil. Their share is about 50 million of that, which could be worth at $20 profit per barrel about $1 billion to them. Yet the value being ascribed to that project is zero. It's literally zero. So there are big opportunities to be had in that space for sure. Look, the challenge. I think the challenge that you face by not investing in the large cap companies is you get much more volatility and much less liquidity. If you like the space and you want to sleep better at night, perhaps your approach, Greg, is the better one. Invest in the larger caps. If you change your mind, you can get out pretty quickly, and you're not likely
Hasn't
to
done
see
well
the.
for Woodside in the last 12 to 18 months.
Okay, all right, fair enough. But again, if you change your mind, you can get out pretty quickly.
That's coming from a Woodside shareholder, by the way.
Right. Okay. Look.
But you're
I
right. It's
feel
only
you
liquidity if you change your mind.
as a contrarian investor. I feel you. That's often how I feel. I feel it both in my professional life and also as a tragic follower of St Kilda Football Club. I am forever irrationally optimistic. I like to think, at least with investing, it's rationally optimistic.
Well, that's what we try to tell ourselves. Hey, just wanted to. You mentioned before you set up the Special Situations Fund for gold a couple of years back. Obviously, the gold stocks certainly in the last 4 to 5 months have done very, very well. How
Very
are
well.
you seeing that space now? Do you think we're sort of getting to that point of value realization, or do you think there's more upside?
Goodness, I mean, gold is a very interesting space. We first invested, I think, when spot gold in USD was around about $1,800. And there was some variance of opinion within the office as to whether or not gold prices should go higher. Certainly, there were a lot of tailwinds. We saw record buying by central banks. We saw a significant uptick in consumer purchasing. I think at the time, and I think still it's probably true now. China and India, from a jewelry perspective and a consumer perspective, represented about 50% of transactions,
Yep.
and we've seen really, really big strength there. We've also seen, probably more now than a couple of years ago, although maybe not, certain national actors looking to move their assets out of US denominated currency. And I think gold is a good option there. But our take was, let's buy companies that don't require a higher gold price. Let's buy companies that are fundamentally good, that have been left behind as gold got to $1,800 from $1,000 a couple of years ago. And that's how we built our portfolio. Now, don't get me wrong, gold price is going to $2,950 or thereabouts as we sit here today, has been very, very helpful. But I would say the jaws between what gold prices have done and what you'd expect to see from company share prices is still very, very wide. Um, it's hard to know if gold prices will go higher or not. But I think even without that, I think there's a lot of catch up to be had by large cap companies, mid cap companies, and small cap companies. But just from a macro perspective, if you want to have a chat about gold because it's fun, the last high, the last cycle probably ended in 1980. That was our last high. On inflationary adjusted basis, that would put gold prices at around about 34.50. So we're getting close. We're getting close to that. If you look more long dated, and I know gold obviously has a history of thousands of years, but if you look at the last 100, 150 years, I think what you'd find is that most cycles last about 20 years. And over that cycle, you tend to find, I think at the weakest, that from the base point until a peak point, about a 5x return. So again, this is completely speculation, and
Yep.
data in, data out, depending where you start from, your outcomes might change, or your analysis might change. But I'm prepared to venture that this cycle probably started around about $1,000. If we're correct, and this cycle is just beginning, and we're correct that history is a good judge of what's going to come forwards. And I know ASIC will hate us saying that because according to ASIC, past performance is not a good indicator of future results. But if that were to hold, then you could see gold prices much, much higher. And certainly if that's the case, you would expect to see companies that produce gold, especially if they're producing gold now or very close to producing gold now, especially if they've got low all-in sustainable costs, you should expect to see them doing very, very well over the next couple of years. So a
And
lot of
certainly
caveats there.
of course, but certainly from a psychological perspective, you haven't seen that craziness in the gold market. Like if I look at, how much attention was put on data centers and AI over the past couple of years, and you look at companies like NextDC, which have been rolling over their share prices over the past sort of 6 months. They've hit their peaks last year. They've been rolling over. With gold, it doesn't feel like we're at that point where there are so many people involved that there's no one else left to buy. So from
No,
that perspective, I think there's some upside there as well.
I think you're right there. I mean, interestingly, we saw some Chinese insurance companies being given a directive by the government that they ought to be investing some of their reserves in gold, and that had a not unmeaningful impact on gold prices. But you've got to keep in mind, it's been very hard to get a gold mine up. It's sort of been caught up in the cultural conversation that we were discussing earlier. It was very hard, even for gold companies, to get financing recently. Um, and there is potentially, a fair amount of upside. Um, I don't think the market, you know, I think what you find is that when the market gets excited about a sector, it starts to predict all sorts of really, really exciting earnings increases and whatnot. I recall it wasn't that long ago that we threw away the concept of a price to earnings ratio for the buy now, pay later space and started talking about, price to revenue or price to addressable market. I
Yep.
think if you look at the gold market at the moment, I don't think the market's even recognizing 28.50. Oh, sorry, 29.50. I think the gold market. I think the stocks within the gold sector are predicting a pullback in gold prices, a
Yep.
significant pullback in gold prices, and I just think that's unlikely given everything that we've seen and our understanding of the space. That's not to say that all companies will benefit. If you run a company poorly or if you run out of capital, and certainly there have been many, many mining companies and commodity companies in Australia that have gone through cycles and just not been able to hold out for long enough. But it certainly appears to us that the gold market is moving and that there are many gold stocks that ought to do very, very well. We were probably 6 months early. I think we've generated about a 40% return in the last 2 years in that gold fund. But had we waited just 3 or 4 months, that return might have looked more like 75, or maybe as much as 100%. So timing is certainly important. But I think we're very much looking at the beginning. If this is the beginning of the cycle, I think it's very much if this is the new cycle, I think it's very much the beginning of that new cycle.
And what a couple of names that you like in the sector?
Look, I mean, West Gold's done pretty well for us. I've had a few hiccups recently. Ramelius we've held. Catalyst has done very, very well for us. Black Cat Syndicate has done very well for us. We've found value across a range of, I would call, larger mid cap all the way down to small cap. Again, I think the goal is really finding a company that can come into production soon with a low all-in sustainable cost. But perhaps equally as important as that is finding the right kind of management. I think especially when you're investing outside of the mega caps, it takes a special kind of individual to fundamentally break a large cap company. And we've met some of those individuals along the journey. But that's not true of mid cap and small cap. You very much are at the behest and the interests of the directors. So you want to
Yep.
find them being competent capital managers for sure, but you also want to find them being co-investors in the equity. So if you can find good projects in tier one jurisdictions, low oil and sustainable costs with aligned management, that's what we're looking for fundamentally. We've built a basket, and so we can buy very small companies, but we're buying just a little bit of those small companies. The further up the scale you go, the more comfortable you can get buying larger stakes. But we've certainly found value across the whole spectrum.
What do you think of West African Resources? Is the political risk just too great? I mean, it's a very well run company, very cheap.
Yeah, look, we owned quite a bit. We owned I think of three or four, maybe even 4 or 5 companies with West African and African exposure. Um, when we more recently, and by more recently, I think in the last 9 to 12 months, have started to see some of the unrest there, we sat down and discussed whether or not it was worth it to take the additional risk for the reward. And again, the answer might be in a vacuum, maybe yes. I mean, again, some of these companies are really, really well run, and what is the genuine risk of rebels turning up with AK-47s and stealing reserves? I don't know what that is, but the truth is there are so many opportunities in jurisdictions that make me less uneasy, where the
Yep.
upside is so great that I'm not sure, for us at least, and for our client base, that it's a risk worth taking.
I feel like that's going to be a good barometer of when the gold market is reaching a peak. I remember in I think 2012 there was a company called Griffin Metals, I think, or Griffin Gold, and it had West African assets, hadn't even been developed, and it was worth billions because of the gold fever at that time. Whereas you look at the West African miners at the moment, no one wants to go there. They're on very, very low multiples. West African Resources itself has got another mine coming on later this year. It's going to be a 400,000 plus ounce producer at very low cost, generating significant cash flows. No one's interested. So to me, that's going to be my barometer of when the gold market's really heating up, when people decide to put that risk aside and chase those returns. Final couple of questions. Just wanted to ask you. We spoke earlier about portfolio management, concentration. How do you feel, or how do you think about what weighting you put in certain stocks? Obviously, the best ideas will take a higher weighting. Do you have maximums that you sort of limit out at?
Look, we tend to think that if we're prepared to put in the effort, and we do, to find an idea, we want to put enough in the position that it can have a meaningful impact on our portfolio over the long term. So we tend to find ourselves investing between 5% of our investable capital in a particular position, and as much as 10% in the first instance in any particular idea. That's not to say that doesn't shift as share prices go up and down or opportunity presents itself. Certainly it does.
Yep.
I would say, if it were my personal portfolio, I'd be happy owning 3 or 4 of my favorite ideas, and be damned the volatility and be damned the risk. I'm young enough that hopefully I can make it back, and I'm confident enough in those stocks that I expect to do well. I don't think that's an appropriate approach to take when you're investing on behalf of other people, and so we think between 5 and 10%, which gives you around about a dozen odd positions, is around about where you want to be. In terms of, I suppose what you're asking is, when do you actively manage a position? Is that your question? Like, at what point do you start to say, all right, we've got to start trimming?
Well, it was more like, what are your initial position sizes, and then how do you manage those as you go along?
Yeah. So look, 5 to 10%, if a share price goes up, we don't tend to trim it unless it gets unduly large or we get very, very close to intrinsic value. If a share price goes down, we'll buy more to top back up to what we think is an appropriate weighting. What we've found historically is that when a stock gets to around about 20% of the portfolio, and that has happened once or twice, we will start trimming it, even if we still have a high degree of faith in that company, because the last thing you want to do is become the fund that really is just that single position exposure. And you've certainly seen funds that have become that over the journey. We don't want to be that. Again, we're not pitching the idea of diversification for the sake of diversification, but for the benefit of our investors, well-being and state of mind, and for the benefit of reducing at least a little bit some of the volatility within the portfolio. We think about a dozen positions is about right. Again, I recognize that that's still quite concentrated, and I recognize that we are not a fund for everybody. But for investors who do have the outlook that we do, that share our philosophy, that are comfortable with the concentration and the volatility that comes with, if they recognize that that volatility is the price you're happy to pay for our performance, then that's the sort of investor that we'd like to attract. And historically, we've been able to do that. So I suppose it's a double-edged sword. On the one hand, you've got performance, and on the other hand, you've got volatility. If you're happy to suffer the volatility, then hopefully, if you do the right sorts of things, if your process works and it's repeatable, then hopefully you get the outcomes. And thus far, we've been quite successful in achieving that.
Right. A final question. Give us a couple of book and or podcast recommendations. What are you reading? What are you listening to?
I would say that two of my favorite books would be for newer investors. It's worth reading Peter Lynch on, I think it's called One Up on Wall Street, where he discusses how the average person in the street probably has more insight into the markets than they appreciate. Just anecdotally, I recall a few years back now where we were looking at investing in Myers, and the numbers looked good and management were telling a really good story. And I went to my daughters, who at the time I think were young teenagers, and I said, "Hey guys, do you want to go shopping on the weekend?" They were like, yeah, let's go shopping on the weekend. I said, "Would you like to go to Myers?" And their response was pretty emphatic, and we did not invest in Myers. And again, sometimes the man on the street knows more than Wall Street does. So I think that's a very, very powerful book worth reading. I think if you're a fan of human psychology and how it intersects with investing, I think the absolute go-to book, and if this is the sort of podcast you do, I'm sure it's come up many times before, but Thinking Fast and Slow by Daniel Kahneman is just an absolutely amazing book. I do find it ironic that the premise of the book is that people don't like to think, and it takes a lot of intellectual energy to think beyond your initial gut reaction. Yet the way he's written the book is that every single paragraph requires that you think beyond your gut reaction. So it can be an exhausting read, but it's just a phenomenal, phenomenal book that will give you insight into both the markets, and at least for me, when I read it, insights into yourself.
Absolutely. I think that's for me, that was the key takeaway. It made you understand how we think without even thinking that we're thinking, which is a really good tool to have when you're making investment decisions, because so many of the investment decisions that we make, especially when we're starting out, snap emotional decisions. We're using heuristics, rules of thumb, where we just want to cut the pain, the emotional pain, or we're sucked in by the emotion of greed. But that book is a really good one for making you an observer of yourself rather than just being caught up in the emotion of it all. And what about a podcast? You a podcast listener?
I'm not a big podcast listener, to be honest. I
You
like
got
to get
6
caught up.
kids, so I can understand why.
Look, I mean, I occasionally get caught up in listening to political podcasts or to political news and things like that. That's quite enjoyable for me. It's been, you can be conservative, you can be progressive, you can argue on the points, but I don't think anyone can argue that it's certainly been, a very entertaining 10 years on the global political sphere. So that's always interesting. And I think there's value on keeping your pulse on the political and cultural atmosphere. I think it does impact where you might be able to find opportunities later. So I don't listen to a lot of financial podcasts, but I do read quite a bit.
All right, I think we'll leave it there. Just before we go, if people want to follow those quarterly insights, I'll leave a link to the note that goes out to this. But just quickly, how can they find you?
Greg, I think the easiest way to find us is probably through our website. It's csvf.com.au. We are a boutique firm, so jump on our website. If you want to give us a call, give us a call. We're always happy to have a chat.
Lovely. All right, well, speaking of chats, I've really enjoyed our chat today. Thanks very much, and we'll catch up again soon.
Greg, it's been a treat. Thank you so much.